Hello, welcome to today's webinar, Mitigating Key Risks in the Directors and Officers Insurance Marketplace. My name is David Garrigus, Executive Vice President and Practice Leader for the Professional and Executive Risks Practice, ProEx practice at Hub International. During our session today, our panel of experts will discuss updates on the Directors and Officers market, including nuances to completing an IPO or SPAC IPO, as well as identifying potential issues and changes in the legal and regulatory environment. Let's review a few housekeeping items so that you know how you can participate in today's webinar. First, we will be recording this webinar and we'll send the recording to all participants later this week. Also, you may submit questions or comments during the presentation in the questions box. We will be reviewing them as they come in, and we'll have Q&A at the end of the presentation. As well, after the end of the webinar, you will see a survey pop up before exiting. Please take a few seconds to fill it out, as we greatly appreciate your feedback. Now I have the pleasure of introducing to you our panel of experts for today's webinar. Adriana is an Executive Vice President and leads the Executive Liability Practice for Hub California. Andrew Costoff is a Vice President with the ProEx practice and leads the public company team in Chicago. And Whitney Ross is an Executive Vice President and North American Claims Leader for the ProEx practice at Hub. Now let's get started.
Great, thanks, Dave. So we're going to start the webinar by giving a high-level overview on where we are in the D&O marketplace, and most of this webinar is geared towards public companies. So the D&O market really shifted in 2020 after years of hard market conditions, soft market conditions. Overall, pricing on an aggregate basis had been decreasing for a number of years. Federal security class action filings climbed every year from 2012 to 2019, and we're seeing significant consolidation in space from the carrier side. So you probably saw a lot of the large mergers like Liberty and Ironshore, Chubb and Ace, XL and Callan, Navigators and Hartford, and the D&O marketplace had been shrinking on a whole. So we had those major windfalls combining with the COVID-19 pandemic, which led to one of the hardest D&O markets in recent years. So what happened? Carriers became much more conservative with their offerings. We saw reduced capacity, increased pricing retentions, and coverage restrictions being included in D&O policies. And specifically, clients who were affected by the pandemic, such as retail, hospitality, brick and mortar, companies affected by supply chain issues, were seeing very restrictive terms, if any at all. So this hard market continued for the next 2 years, but what we've seen since then is the D&O market trending much more favorably. So it appears that COVID-19 didn't have the initial impact on D&O claims that carriers anticipated, but as Whitney will get into later in the webinar, those have started to pop up again. And since 2019, federal security class action filings have actually decreased for 3 consecutive years. Next slide, please. We're also seeing new capacity come into the marketplace in the US and overseas, which has increased competition amongst D&O insurers. And one of the biggest stories of the past few years has been the dramatic increase in SPACs and IPOs, which has slowed down significantly starting in 2022 and continuing to this year, although we are still seeing claims in that space, and we'll be diving deeper into those areas later in the webinar. From the insurer standpoint in 2023, some carriers have tried to remain disciplined during the softer market, but overall, we're seeing more competition than we've seen in years. Carriers have had much more aggressive appetites and willingness to quote, and we are seeing more capacity on placements than we've seen in recent years. So limits up from 2.5 to 5s to 10s to even higher, along with pricing retentions that have come down significantly as well. We're also seeing more carriers willing to offer primary indications with enhanced terms, along with lower excess rates than the years past, but perhaps the biggest change in the market has come in the IPO and de-SPAC pricing, as those rates have been reduced significantly from 2021 levels. But it seems like generally speaking, carriers are quoting more towards market conditions instead of rating relative to exposures. In terms of key issues in 2023 from a D&O standpoint, future concerns for D&O insurers are the potential of a recession with the volatility in the market. Inflation is currently at dangerous levels with the concern about insurers' ability to refinance in terms of rates and what will those interest rates be when companies do refinance. And although we're over 3 years out from the pandemic, questions remain regarding how are companies going to manage those supply chain logistics, although we're seeing some companies make major investments to circumvent that. Diversity and inclusion and ESG has been and will continue to be a major boardroom issue as underwriters are trying to get their arms around the risk from a D&O standpoint. And ESG specifically for clients who have an exposure, we're seeing more questions from underwriters such as, what are your disclosures? How proactively are you monitoring ESG? Have you had any sort of issues? And if so, what proactive measures have been taken? But the question still remains, will you be sued for an ESG related exposure? What are the allegations and could this have been prevented? But ESG metrics certainly can have an impact on financial performance as well, either from an overall operational cost or from the cost of litigation itself. And companies who don't manage ESG correctly will likely experience higher capital costs and more volatility. Political risk, still a concern for underwriters, specifically with Ukraine and Russia and how global markets are being affected, including the impact of consumer and energy prices. Some insurance carriers are asking about overseas exposure and is there any involvement from the US directors and officers? And then with the recent banking failure, there will be increased concerns regarding potential D&O coverage from underwriters, particularly within the financial institution space, where we're likely to see more stringent underwriting, potentially reduced capacity, and policy language being amended, as we've already seen several class action filings. But overall, a lot of questions from D&O insurers regarding the economy and its impact on clients as they try to remain disciplined. But we do expect to see more favorable pricing and coverage terms and conditions in 2023, along with new capacity to enter the marketplace. Now, I'm going to hand the presentation over to Adrian to go over to IPO and IPO readiness.
Great, thank you, Andrew. Hello, everyone. So we're going to talk about IPO readiness, but first let's talk about how these policies work. As you heard Andrew say, pricing's coming down, deductibles are more favorable. It's trending in your favor. But understand how the underwriters who provide the coverage, how do they think, how do they operate? They think in terms of coverage A, coverage B, and coverage C. So when you buy directors and officers liability insurance, you've got to put that selfish hat on. Yes, you're buying coverage to protect your balance sheet, so the enterprise, but you're also protecting your personal assets, your net worth, everything you've built over your career. Coverage A is going to protect directors and officers for non-indemnifiable claims. We'll talk more about those claims later, but no deductible or retention applies. The insurance pays $1. Coverage B, again, suits targeting the directors and officers will trigger here, but this is a mechanism to reimburse your company's balance sheet as the company indemnifies you. By the way, a good practice is to always dust off and take a look at your indemnification agreements, look at your company charter, the bylaws, look at your state laws. How are you protected if there was no D&O insurance? Because the D&O insurance is really the backstop to all that. And then coverage C is going to protect the company itself when the company is targeted. Employees are covered. And whether you're a nonprofit organization, privately held or publicly traded, you want to understand A, B, and C and understand the coverage value to you, but you also want to understand why you buy the coverage. Every organization has its own story. Some companies buy to protect against the bankruptcy risk when the creditors line up, employees line up, when you go into Chapter 7 or 11. Other companies are really focused on regulatory risk, concerned about SEC or DOJ investigations, FTC investigations or suits. And then there are other companies, typically privately held, that really focus on customer supplier claims. So let's push forward and talk about the IPO process as a next step. And in looking at this illustration here, again, you're getting into the mind of an underwriter, but also this is the structure that you're going to want to speak about to protect all past, present, and future leaders of the organization. This is maximum protection. So as you can see from the illustration in the dark blue boxes, we have side A, B, and C. We just covered that on the previous slide. But then in the gray box, there's a product called side A, excess DIC, difference in conditions. That's a good thing, as you can see from the black drop-down arrow. What that gray policy will do is actually become your safety net as a leader. The illustration shows that the protection does not extend to coverage B or C, meaning the company doesn't have access to that policy. It's preserved only for directors and officers. We can thank Enron and WorldCom 23 years ago, if you remember those days, for this product. That's where this product was developed. And over the years, it's really transformed into a best-in-class policy, depending on the insurance company you buy it from. But ultimately, this is the structure you're going to want to look at purchasing. And again, it doesn't matter if you're a nonprofit organization, privately held or publicly traded, have this structure in place, or at least be educated on how this structure will provide you the best protection possible. The dark blue boxes, the gray box, you may layer it up in different layers or limits, which we'll talk about next. But let's talk about, again, going IPO. Next slide. So as a privately held company, you're going to want to make sure you're working with your broker to dive into the policy to first off see that there's roadshow coverage. Leading up to the IPO, as you're well aware, and working with your attorneys and your bankers, you're going to be conducting meetings, talking about why it's favorable for the organization to go public. And so all those conversations creates prospectus liability. And the roadshow protection under a private D&O policy is there in the event you do not go public. And we've seen those stories over the years where organizations just decide at the last minute not to go IPO. They don't like the pricing. Maybe they couldn't fill the board book. Maybe they sell the company because a private buyer comes in at the last minute after reviewing the S1. There are several different reasons as to why companies don't actually finish that initial public offering. The roadshow protection under the private D&O is so important. So make sure you check that box. With respect to runoff coverage and backdating continuity, you have choices there. We lean towards backdating continuity. So the IPO coverage that you engage the day you start trading, you're going to make sure that that new IPO coverage is actually backdating to cover you for any wrongful acts you're accused of dating back to the inception of your organization. That's a good thing. And in doing so, you're going to ask for unearned premium credit when you cancel the private coverage that you've had in place. So again, you've got choice there, working with the underwriters as to whether you want backdated prior acts coverage, as we call it, or not. Moving forward to the increased limits, how much do you buy? What you're going to find is that the underwriting community is going to want to meet with you and talk to you, hear your story. Why are you a good risk? Who's leading the company into the transformation of going public? And then you're going to ask, how much do we buy to protect the people and the company, the enterprise? You're going to have new board composition. You're going to have new personalities wanting to push for higher limits. But what is that zone of reasonableness, as we call it? So we highly recommend you look at analytics. You're going to know what your anticipated market capitalization is going to be. So what's that range? What's the offering amount? And by the way, those are two figures that the underwriters are going to want to know as well. They're going to use those two metrics as a baseline to price out your D&O insurance protection when you go public. Your deductibles, we'll just call them retentions, will be higher. Premiums will be higher because the risk is at a different stratosphere. We'll talk about that next. And then, as you saw from the prior slide, you're going to want to take a heavy look at the Side A DIC coverage. How much in that coverage do you purchase? It's very important to maintain continuity of the existing policies, so backdating prior acts, the knowledge qualifier, as we call it. And then there's some other policies. As a privately held organization, you've had the benefit of buying employment practices liability, fiduciary liability, and perhaps crime coverage, all rolled up with your D&O with one insurance company. When you transition to a publicly traded organization, you now have to separate all those policies out and look at standalone policies. So you can take a look at extending out those policies, writing them fresh on a go-forward basis with prior acts coverage. There's communication here with those underwriters as well. So we want to make sure that you understand it's not just directors and officers coverage that you're speaking to the market about, it's these other coverages also. Moving to the right hand of the slide with the timeline, we like to work backwards. So let's start with the day you start trading as a new publicly traded company. You're popping the champagne, everybody's put in the work. That is the day you're going to bind up this new public D&O tower, let's call it. So the layered cake with the limits of liability that you've all decided to purchase. On that same day, you're going to cancel the private coverage and look for that unearned premium. But working backwards, the last thing you want to do is look at the terms and conditions, all of your options for your public D&O insurance program while you're on the roadshow. So it's important in working backwards that you are able to review the final proposal before that roadshow begins. And the underwriting document to kick off the entire process with the underwriters is your S1 filing. So if you're like most and you're working on a draft S1 under the Jobs Act, you want to make sure your broker secures NDAs in place with all the insurance companies so they can start early, a month to 2 months early, even further out to review that draft S1, schedule the meeting with you to present to the underwriters your story, your narrative, why you're a good risk. And then the underwriters understand that S1 is going to change a little bit. The timing of the IPO is a moving target based on SEC feedback, et cetera. But you're going to want to make sure that that the underwriters do get an early look and that you're able to present. Okay, and by the way, this applies if you're doing a de-SPAC business combination, which Andrew will talk about next. It's going to be the S4 document. Next slide. So your exposure is much higher when you go public. You're under the 33 Act, so you have prospectus liability. So the exposure is real. The duration of that exposure is 2 to 3 years, depending on which underwriting carrier you talk to. But what the plaintiff's attorneys know is that in coming after you with this suit that may be successful against you, they don't have to prove scienter under the 33 Act. So that's the intent to deceive the public, the intent to commit fraud. All they have to find is a mistake in your S1, maybe a misstatement on your roadshow. The bar is very low. Why do we share this with you? And you're going to hear it from your attorneys, your bankers, and other parties in that ecosystem as you prepare to go public. We share this with you because it justifies, in a way, why the premiums are higher when you buy IPO D&O insurance. Expect to pay those higher premiums for the next 2 to 3 years with higher retention levels as well. But again, as Andrew said, we're in a good marketplace. We're in a softer market, so there's more competition, more carrier appetite. What we tend to do is build out a matrix, a budget matrix to get you ready for that. So the timeline below just shows that exposure window. Once you're outside the 33 Act, you now move to the 34 Act. You should see some premium relief at that point with your insurance. Next slide. So what we're illustrating here on the left-hand side are the table stakes to represent you well in this marketplace. As the broker, you're going to want to have high leverage, high volume premium with all the major insurers. You're going to want to have attorneys on staff like Whitney Ross, who's going to speak in a bit, reviewing the contracts, looking for the best coverage value, including working with coverage counsel, outside coverage counsel, claim advocacy, analytics at your fingertips, and of course, peer benchmarking and industry experience. What we like to do in the current state, knowing that the underwriters are making you work for the bells and whistles, premiums are coming down, deductibles are coming down, but the underwriting community is saying you better know what to ask for, is making sure that we have analytic tools to get you to the right amount of coverage, but also the contract value. Always remember, this is a legal buy for you. So you've got to look at the language and work through your broker to make sure that that contract is as broad as possible, especially in the current marketplace. Next slide. I'm going to hand it back to Andrew to talk about SPACs and de-SPACs. Andrew?
Great. Thanks, Adrian. Appreciate the update. So let's get into SPACs and de-SPACs on the heels of the IPO update. So I think most individuals on this call have a pretty good understanding on what a SPAC is and how they operate. But at a very high level, a SPAC is a shell company, sometimes referred to as a blank check company, set up for the purposes of acquiring a private company and taking them public via reverse merger. So there's no operations. They're typically set up by a sponsor group with funds for an operating account, and they have 18 to 24 months to complete a transaction, unless they extend, which we're actually seeing quite a bit of as of recently. So, at that point, if they don't and they decide not to go through the transaction, they would have to liquidate and return funds to the investor. So from an insurance standpoint, there is a very high D&O exposure with SPACs, specifically the non-indemnifiable component, otherwise known as Side A that Adrian touched on, since most SPACs have very limited operating funds available and have issues with indemnification. So from an overall program structure standpoint, many SPACs are buying significantly less D&O insurance than traditional IPOs due to the cost and not enough operating capital to purchase adequate limits. So the Side A is extremely important. So we always recommend at least some form of Side A over primary ABC to help protect the directors and officers. And we'll get into runoff a little bit later, but the runoff for SPACs is very important because a majority of the D&O claims made against SPACs come in after the transaction is completed. So one of the benefits of the market is the D&O market has softened to the point where some insurance carriers are willing to offer prior acts coverage on the SPAC target, as well as the SPAC itself, which is relatively new in the market. So the SPAC has the ability to get much higher limits than they were previously under potential SPAC runoff policy, depending on how much limit was actually purchased. And runoff costs initially were very high. We're seeing those prices come down as the market's trending more favorably, and we're even seeing a lot of those programs being run off. But there is a potential that the SPAC might actually want that contract certainty of a runoff policy and not wanting to rely on go-forward prior acts coverage. For the SPACs that are liquidating, we're not seeing as many purchase runoff policy, but those rates tend to be lower than those actually complete a transaction. So let's talk about the key parties of the SPAC. Let's move to the next slide. The sponsor is responsible for putting the deal together. And it's typically a private equity group, venture capital, or a serial SPACer, which is a group that's previously worked on prior SPACs. And the sponsor may have some involvement in the go-forward de-SPAC entity, either a small ownership percentage or possibly a board seat or two. There's the investors who can get incentives depending on the warrant structure if they choose to exercise. And lastly, there's a target who at the beginning of the search phase cannot be identified by the SPAC. And SPACs can generally only indicate their target industry or geography. But there's a lot of advantages of a private company using SPAC to go public. The obvious example is a much quicker route in doing so. The administrative costs can be significantly lower. And there's typically less regulatory involvement, but important for the private company, the SPAC itself can provide them with a team experience in their sector or industry. Let's move to the next slide. So, we had the explosion of SPACs in 2020 and 2021, but last year we saw a significant drop off in the number of SPACs going off. Which is primarily due to proposed changes from the SEC, poor performance by a lot of SPACs, heavy litigation exposure, and just overall volatility in the market. And when you look at the overall federal security class action filings, SPAC filings were the most dominant trend in 2022. So litigation is still a major concern for SPACs from the SEC and plaintiffs' firms and D&O insurers, specifically with how they're classified. What's the warrant structure? Was there adequate due diligence around a transaction and compensation incentives? So interestingly enough, for SPACs that were liquidating, a large portion of them were not purchasing any runoff due to the perceived decreased exposure, but we've actually seen a number of claims coming in against SPACs who haven't closed on a transaction and have liquidated. So there still is the very real possibility of potential litigation. With the claims coming in, we'll likely see more SPACs that are liquidating at least consider purchasing a tail policy, but at this point it remains to be seen since it's a cost that most SPACs just don't want to pay. Next slide, please. So overall, we're expecting to see the trend for SPACs to continue to decline in 2023 as more SPACs aren't finding targets within their designated search period and decide to liquidate. So it will be interesting to see if 300 plus SPACs looking for targets in 2023 are able to close on a transaction, or if they end up liquidating and return funds back to the investors. Now I'm going to pass the presentation back to Adrian to go over mergers and acquisitions and runoff issues.
Yeah, thanks, Andrew. Okay, so let's go to the next slide. This is a helpful illustration and a good refresher as to what runoff is. The other term, by the way, you can, aside from runoff, is tail coverage or discovery coverage or extended reporting period. But ultimately, if we're talking about SPACs first, as you heard Andrew say, we're in a different marketplace, a better marketplace. You do have choices now. So you could find insurance companies, once the SPAC sponsor finds the private company and the deal consummates, they de-SPAC, you could find an insurer that will provide full prior coverage for all organizations involved, all entities, therefore no need for runoff. But that's going to be the choice of the board. You've got to talk about the pros and cons there if a claim were to come in. But if you don't have prior acts coverage, what this illustrates is the seller is going to have to purchase runoff or procure runoff or tail coverage. That's the blue illustration down below. Typically, it's the buyer that pays for that, but both parties do benefit. So clearly, if you're the seller, your board benefits, you're protecting personal assets of seller's board, the officers, if they're sued by the buyer or other parties, regulatory investigation could come in, shareholder suits. There's a long list of potential claimants, but the buyer also benefits in purchasing runoff because in a way the buyer is protecting the asset they just acquired, right? So if outside claimants come in against that asset that they just paid for, they can tap into the runoff policy as well. The green portion up below represents the buyer's coverage. So we're often asked, hey, do I need runoff? Do I need tail coverage? Because the company that's buying us already purchases D&O insurance protection. So why do I need it? Well, the reality is the buyer's coverage, again represented by the green arrow, is going to pick up the target company, the seller, but only for alleged wrongful acts they're accused of post-close, which is why we have date of closing reflected there with the black arrow. So there is a divided line here, and we wanted to illustrate why the runoff coverage does benefit seller, also buyer, and then how the go-forward coverage operates as well. So this illustration applies to any organization that sells ultimately, privately held, publicly traded. It's a good refresher as to the mechanics of the coverage. And in working with your outside attorneys, they will include this discussion point within the purchase and sale agreement. Okay, now I'm going to hand it to Whitney to talk about litigation trends. Whitney.
Thank you. So what does this all equate to? So why are we talking about the importance for insurance coverage for public companies and their directors and officers? Well, because the exposures faced at various stages in the life cycle of a company going public, being public, or even going private. So for our litigation update, we're going to break this down into a discussion around securities claims and regulatory actions. Last year, there were 208 securities class action lawsuits filed. This was a 10% decrease from the number of securities class actions filed in 2021, and a 14% decrease from the average number of securities class actions filed between 1996 and 2020. Last year was the third straight year of decline for securities cases, as Andrew had mentioned earlier in our presentation. Looking back historically at the higher number of filings, I think these numbers likely had to do with an increase in merger objection lawsuits. But in breaking down 2022, the main categories of securities class action suits fell into what we describe as event-driven litigation. Event-driven lawsuits emanate from repeated issues that we often hear about in the news, like the Harvey Weinstein scandal, oil spills, ransomware attacks, and others. There are events that oftentimes tap into the emotions and concerns on a widespread scale. Event-driven suits filed over the last several years have not really targeted a particular industry segment. We've seen hotels and restaurant chains, online educators, and pharmaceutical companies as just some of the many industries hit by this type of litigation. The event-driven lawsuits with the highest number of filings in 2022 included SPAC-related lawsuits, as Andrew had mentioned, 24 of which were filed, COVID-related lawsuits, 20 of which were filed, and then crypto and digital asset-related suits, 23 of which were filed. The most sued industries, which to me really comes as no surprise, were the tech industry with 17% of filings and the life sciences pharmaceutical industry with 16% of filings. The next interesting piece of the puzzle when looking back at security suits filed, at least in 2022, is what type of claims and allegations were made against public companies. The overwhelming majority of suits involved Rule 10b-5 claims, accounting for 83% of the filings. Those claims are filed under the Securities Exchange Act of 1934, and as Adrian had mentioned earlier, they allow shareholders to file suits for allegations of material misstatements, omissions, misleading statements in connection with actively traded securities. So these cases are usually filed after a negative public disclosure, and then you see a resulting stock drop. And then 21% of the filings involve Section 11 claims under the Securities Act of 1933. Adrian also mentioned, these are a vehicle for shareholder claims based on a material misstatement in a prospectus in connection with an initial public offering, which usually includes the details of the IPO. So in terms of the allegations within the claims, 89% of the filings involved misrepresentations made in financial documents, and 39% of the claims alleged false forward-looking statements. So late last year, a plant-based food company called Tattooed Chef was sued alleging its financial statements for the past year included errors such as overstating revenue and understating losses. And as a result, the company would need to restate its previously filed financial statements. So that's just one example of this type of suit. Another recent filing included a securities claim against Twist Biosciences. That's a biotech company that manufactures synthetic DNA and DNA products. That complaint alleged that the defendants overstated the commercial viability of the company's synthetic DNA manufacturing technology, and engaged in accounting fraud and used unsustainable pricing to inflate the company's true financial condition and future prospects. So that's just another example of sort of what we're seeing right now. Both of those cases remain pending. So naturally, we wonder who's behind all of these securities lawsuits, like who is filing these claims. I don't think it's a secret. There's a group of plaintiffs firms that routinely seek out class members and file securities cases. In 2022, two groups of law firms accounted for 60% of the first identified core securities filings. The first set of law firms that I typically refer to as the A-team that goes after those large damage claims include Robbins Geller, Bernstein Litowitz, and Labaton Sucharow. And the second set of firms include Larry Rosen, Pomerantz, and Glancy Prongay. While we could dive deeper into these firms, we won't have time today, but notably, last year, Robbins Geller received the top spot for total securities class action settlement funds recovered at $1.75 billion. Bernstein recovered just over $800 million. Both firms were involved in the largest settlement recorded in North America last year, which was the Twitter settlement for $809 million. There, the judge awarded $182 million in attorney's fees. So let's move on to our next slide. Okay, shifting gears from securities litigation to regulatory actions, which are often filed parallel to one another. The SEC has certainly taken an aggressive approach. Just looking at these numbers, last year there were 760 enforcement actions filed. The SEC recovered a record $6.4 billion in penalties and disgorgement on behalf of the investing public. There was an obvious focus for individual accountability. The SEC has started really working with their regulatory agencies, including criminal law enforcement, and they won 12 of 15 trials. It's really no secret that the SEC is heavily focused on cybersecurity and compliance by companies in the US. Last July, the SEC separately charged JP Morgan, UBS, and TradeStation Securities for deficiencies in their programs to prevent customer identity theft in violation of their theft red flag rule. The JP Morgan order alleged that the firm failed to exercise appropriate oversight of service provider arrangements. The UBS order found that the firm failed to adequately involve the board of directors in the oversight and administration of their theft prevention program. These firms agreed to cease and desist future violations and pay penalties of upwards of $1.2 million. More recently, the SEC settled charges with the data management company Blackbaud, who many of you know suffered a ransomware attack in 2020, which impacted over 13,000 customers. The SEC contended that Blackbaud made misleading disclosures about the ransomware attack. Blackbaud agreed to pay the SEC a $3 million penalty in connection with the action. These aggressive investigations by the SEC are going to continue, and the actions, really highlight their focus on cyber-related disclosures. And then finally, ESG, as Andrew had mentioned, will become a more aggressive focus for the SEC in 2023 and beyond. Just for background, ESG stands for environmental, social, and corporate governance. The purpose of regulatory oversight of corporate ESG is to bring attention to ways corporations operate and disclose performance in the areas of public interest. So a recent example of a regulatory focus on ESG was an announcement last month that Vale, which is a publicly traded Brazilian mining company, agreed to pay a $55.9 million settlement on charges brought by the SEC last April, stemming from the company's allegedly false and misleading disclosures about the safety of its dams prior to a January 2019 collapse of a dam that killed 270 people. The SEC had alleged that Vale's public sustainability reports assured investors that all of its dams were certified as stable. That settlement is currently pending approval by New York federal court, but proposes that Vale pay a civil penalty of $25 million and disgorgement and prejudgment interest of $30.9 million. So what does all of this tell us, right? It tells us that we have to understand our client's business. risk profiles, and be proactively approaching their insurance programs. We have to be smart about structure, policy language, and what analytics is telling us. So on that, I'm going to pass it over to Dave to discuss one unique analytics tool that Hub provides to its clients. Dave?
Thanks very much, Whitney. One of the, as Whitney mentioned, one of the things that our team believes is that clients are well served by being proactive in their approach to understanding their risk and engaging with the market. One of the tools that we employ to give our clients better insight into how underwriters perceive their public D&O risk is a tool called Boardroom Alpha. And this is one of many examples of tools that Hub employs on behalf of our clients. But Boardroom Alpha, in addition to giving certain potential red flags with regard to governance and performance issues, giving performance ratings of the board and other parties, and looking at a number of other factors, very interestingly also gives ESG ratings from third parties. If we transition to the next page, ESG, as was mentioned earlier, has become an enormous hot topic in the boardroom, but also in D&O underwriters underwriting D&O risk. By drawing on those ESG ratings and incorporating those within our proprietary stochastic modeling, Hub can give our clients intelligence into not just how underwriters will perceive their ESG risk, but how they should change thoughts around limit adequacy and program composition as a result, or including, I should say, the relative maturity as it respects ESG. Now, you think about how organizations overall put together and are advised on limit adequacy and put together their programs. Often organizations are relying on traditional benchmarking. But there are a couple of problems inherent with traditional benchmarking. First off is that it's fundamentally a peer comparison model. For public companies, often that means looking at other organizations with a similar market cap. But as many on the line know, you can have two organizations with a similar market cap, even within the same industry, who have very, very different profiles. But even if we can find a really, truly good peer group, then there's the underlying assumption that what they're doing is correct and should be the basis of what you're doing. And we often find issues with that as well. And so Hub has created what we believe is the most sophisticated way of an organization understanding its D&O exposure and what that means in terms of the insurance program. We call it our SCORE models, or stochastic cost of risk. We can do it across coverages, not just for public D&O, but also for all of their other core lines of coverage. But very importantly, as I mentioned, now our public D&O score can incorporate these ESG risk ratings to help a client understand how that impacts their D&O exposure and their program composition. Now we're going to address some of the questions that have been coming in. And checking the questions, we've had some, I think, very good ones that have come in from participants. The first that's come in is, at what point during the process do your claims advocates or claims attorneys become involved when there is a disputed D&O claim? Whitney, do you want to take this one?
Sure. So I can only speak for Hub International, but as the North American claims leader here, I can say that we have a very holistic approach to advocacy, which means that we're present and actively engaged throughout the policy year. So it isn't just when there is a disputed D&O claim. So we collaborate with our broking colleagues during the renewal process. We review policy language, proposed endorsements, enhancement to our clients' insurance programs, since that's the first and most effective way to positively impact coverage and claim results. So we find it to be a necessary part of the process. Of course, we cannot predict carrier behavior or how a claim is submitted. We work alongside our clients throughout the claims process and advocate on their behalf throughout the life cycle of the claim for best outcome.
Terrific, thank you, Whitney. The next question actually is a multi-part question. It says, can you talk more about limit adequacy? How do you determine how much limits public companies should be buying? What types of program structures should they be considering? What types of benchmarking reports do you use to help determine that? Andrew, you want to take this one?
Yeah, no, and I think you touched a little bit on it earlier, but I mean, we're certainly seeing a lot of our clients in this new analytical age trying to rely on newer tools. So I think historically speaking with D&O, clients might look at a certain percentage of market cap, or, I know third parties offer peer-to-peer benchmarking tools. Then it kind of becomes cyclical, because you might want to be buying, what company X is buying versus company Y at similar market cap. But, as you mentioned earlier, Dave, it might be two dramatically different risk characteristics. So, we invest a lot in our score modeling, which looks at actual loss data, which is the most important that you can look at. And it's a Monte Carlo simulation. It projects frequency and severity. So we can look at securities claims versus non-securities claims, 33 versus 34 claims. So if you've got a recent IPO or secondary offering, it actually uses actual loss data and can project certain percentiles based on how severe the claim is going to be. So you get frequency and severity, and it calculates based on a number of risk metrics like market cap, industry, where you're located, what exchange you're on, and we've got third party that calculate governance and accounting score, and it gives you, very real numbers. And then once you actually get premiums in the door, we can run break-even analysis, because I think the D&O market really has a lot to do with how much clients buy, because obviously in a softer market, insurance is cheaper, so you might see clients buy more versus in a hard market. So I think using the loss projection tools are a lot more accurate than saying, okay, I've got a similar market cap size company or similar industry, how much are they buying? I'm going to buy that much. I think using actual Monte Carlo simulations with loss projections is just a lot, more accurate for a client. So I think, that's a big part of what we do. In terms of side A, I know a lot of times board members might have a specific amount of side A that they require, but I think that's a big part of what we do very, very well, and it's just more accurate for our clients and prospects.
Perfect. Thanks, Andrew. Adrian, I've got one here for you. The question that came in said that you mentioned a meeting with underwriters as part of the IPO process. Who typically is in those meetings from the company?
Yeah, good question. Well, you want to start with someone from finance and accounting as well as legal. So we typically will have the chief financial officer or general counsel present within that vein, within those departments. But you can extend beyond that. You can bring in head of investor relations, risk manager, if you've got a risk manager or treasurer on your team, and certainly the CEO. But what the underwriters are looking for is the financial well-being of the organization. So who's manning the cash? What does the burn rate look like? Are you a bankruptcy risk? Once they check that box, they're going to then move to the business itself. Why is it going to be successful? What's trending? And then in terms of governance, so investor relations, communication with your major investors, trading windows, when employees can sell the stock, those sorts of things. These are all boxes they check, but I would start with the chief financial officer, the general counsel, and expand out from there. They also want to make sure they're not looking at a lot of volatility in terms of the stock based on communication, press releases, those sorts of things. I always say boring is good. They like a steady stock without a lot of movement.
Terrific. Thank you, Adrian. Circling back to Whitney then. Whitney, a question came in. If the company fails, what is the most common exposure you see faced by directors and officers?
So losses can be filed against directors and officers by shareholders, creditors, consumers, or the bankruptcy trustee. They can come in the form of alleged securities violations, breach of fiduciary duties, corporate waste. I would say arguably the most common exposures that I see to directors and officers is a bankruptcy scenario where the bankruptcy trustee is filing the claim. So as part of a bankruptcy trustee's responsibilities, he or she has a duty to maximize the assets of the estate and can use claims against the D's and O's to discharge that duty and recover the amount. So either directly from the directors and officers or through the insurance policies. So those types of claims typically take the form of alleged breach of fiduciary duty. So we're looking at duties of care, loyalty, corporate waste, unjust enrichment. The types of claims filed by bankruptcy trustees are unique and a little bit dangerous in that the trustee already has access to the bankrupt company's documents, rendering really the need for extensive discovery unnecessary. Trustees Also don't have to make a formal demand on the company's board like you typically would in a derivative claim before the suit is filed. So, but those are the typical types of claims that I see most often brought in an insolvency situation. And I think it's really important that I think Adrian also mentioned about Side A coverage in these insolvency situations to take a very close look at what your coverages are, because they are a little bit more tricky and a little bit more complex than your typical, D&O claims.
That's great. Thank you, Whitney. All right, we have another question come in. What are the main metrics that underwriters use to underwrite public company D&O? Andrew, would you like to take this one?
Yeah, no, this is another good question. So the two main metrics are typically going to be market cap and industry. With market cap, how much is held versus inside versus public float, probably one of the biggest drivers, because that really kind of demonstrates what the shareholder value is, especially if there's a security class action. Industry, I know we talked a little bit about it, but there's certain industries that are typically going to be sued more than others. And I know, in terms of underwriting, I think there's a number of industries that may or may not be within the carrier's appetite. Adrian hit a lot earlier on this, but are they a recent IPO? Have they done a recent secondary offering, which really is a major exposure for a D&O client? But what does their management team look like? How experienced are they? What's the board composition like? Have they had litigation in the past? Have they had any sort of claims issues? I know we drilled into it a lot earlier, but how do they manage ESG risk? Are they active from an M&A standpoint? What's their business model? And then there's a number of financial ratios and metrics. Are you a solvency risk? Because as Whitney just mentioned, bankruptcy is a huge exposure for D&O insurers. And then are you affected by major windfalls in the economy, like a COVID-19 pandemic, retail, hospitality? But I would say that those are typically going to be the major components of underwriting for D&O insurers.
Thanks, Andrew. All right, I think we have time for one more question. Adrian, I'm going to let you close us out. Are all insurance companies similar, or are there areas you look at to differentiate them in their terms? Great question.
I like the question. No, they're not. The good news is, as you heard Andrew say, we're in a better marketplace. So you're going to have choices in 2023 and 2024. You're going to have underwriters vying for your business. There are a lot of them, a lot of new entrants, over 20. So of course you're going to start with pricing, narrow down the field, pricing, retentions, but look to the contract value. Which insurance company or underwriter is actually working with you on broadening that contract to protect you best? As you heard us say earlier, it's a legal buy for you. And that's another way to narrow down the field. Beyond that, you're going to look at the financial viability of the underwriter. How long have they been in business? What's their rating based on AM Best as an example? You can then look to claims. What's the reputation on paying claims? Do they have in-house claims attorneys and adjusters, as we call them, or do they outsource to outside firms to manage their claims? And what is that reputation? Are they looking to find coverage or deny coverage? So it's good to interact with your broker to get their experience. And then the final thing I'll share is underwriting consistency. You'll never see that in writing from an underwriter, but the broker who's been doing this for a long time will tell you which underwriters are consistent on their communication, on the terms and conditions they provide every year. In other words, they're not going to buy your business today and then hammer you on your first renewal.
Great response. And thanks everybody for the very thoughtful questions. If we didn't get to your question today, a Hub representative will follow up with you. And on behalf of Hub International, thank you for attending today's webinar. Also, we kindly ask that you please fill out the survey before you continue on with your day, and we appreciate your feedback. Thanks. Have a great rest of your day.